Today, we're jumping into a corner of the market that has been, absolutely on fire.
Truly electric.
Yeah, domestic uranium. And we're really focusing on one company, Energy Fuels, Inc., ticker symbol UUUU. And when you look at the chart, it tells a wild story. The stock is up over 200% from its lows in the last year.
A massive climb.
Exactly. So the big question the analysis is asking, and that we have to ask, is for anyone on the sidelines, is it too late? Has the ship already sailed? Or is this just the stock, stopping for fuel before the next big leg up?
And that's really the mission of this deep dive. We're unpacking a really bullish analysis report here, and it doesn't just look at the stock. It lays out a case for the entire domestic nuclear supply chain and how UUUU is set to be the main beneficiary. We're going to connect the dots between geopolitics, this new explosion in energy demand, and then the company itself, its books, its assets, its chart.
Okay, fantastic. So let's start with that macro backdrop. Every good thesis needs a strong wind at its back, and this report calls it a full-blown nuclear renaissance. What's driving this?
Well, what's so interesting is that it's not some abstract future trend. It's driven by hard geopolitical realities happening right now. The report really centers on the U.S. government's aggressive move to ban Russian uranium imports.
And that's a big deal for the U.S., right? We've been pretty dependent on them.
Huge deal. Far from a small problem. The U.S. has historically relied on Russia and its allies, like Kazakhstan, for a huge chunk of its nuclear fuel. So this analysis makes the point that if that ban goes through and it's moving fast, it instantly creates this massive supply hole.
A hole that has to be filled by domestic producers.
It has to be, just to keep the lights on. It's an immediate, powerful market disruption.
Okay, so the supply side is getting squeezed by politics. Now let's flip to the demand side, because this is where the report brings in what it calls the AI factor. This part is fascinating.
It really is. Nuclear power has always been important, but this sudden hyperscale build-out of AI data centers is a whole new ballgame. It's creating a demand that's not only massive, but it's also totally inflexible. The report names Microsoft, Amazon.
Right, the giants.
Yeah.
And they can't just build a bunch of solar panels next to these things. Why is nuclear specifically the answer for them?
That's a great question, and the analysis draws a really sharp line here between just clean energy and what it calls reliable baseload power. Think about it. These data centers have to run 24/7. At full tilt, you can't have intermittency.
If the wind stops blowing, your AI model crashes.
Exactly. A multi-billion-dollar operation goes down. So wind and solar just can't guarantee that nonstop power. Nuclear is really positioned as the only carbon-free source that can provide that massive, uninterrupted power that this AI revolution needs.
So you've got this pincer movement. Geopolitics is crushing supply, and this new tech boom is creating this insatiable round-the-clock demand.
That's the perfect storm. The report confirms that global uranium supply is already incredibly tight. Spot prices are holding at levels we haven't seen for years. The macro environment, according to this analysis, is just about perfect for any domestic producer who's actually ready to go.
Which is the perfect segue to zoom in on Energy Fuels, on UU, because in a hot sector, you get a lot of pretenders. Why does this report single them out?
It all comes down to one strategic, basically irreplaceable asset, the White Mesa Mill in Utah.
The White Mesa Mill.
Yeah.
Okay. The report calls it their crown jewel.
And for very good reason. It is, as of right now, the only operating conventional uranium mill in the entire United States.
The only one. Wow. Okay, help me out. What does conventional mean in this context? Why is that so important?
It's a key distinction. A lot of other companies use a method called ISR, where they basically pump liquids into the ground to leach the uranium out. That's fine for certain types of deposits. But a conventional mill, like White Mesa, is an industrial facility. It can process ore from many different mines, their own mines, or they buy from other miners.
So it's a central processing hub.
Exactly. It gives them scale and flexibility that ISR operations just don't have.
So while all these other hopefuls are maybe, drawing up plans and facing years of permitting to build something like this,
UU is already there. They're licensed, they're staffed, they're running. They are, as the report says, already in the game.
That's a serious moat. They can step into that supply hole from the Russian ban today, not 5 years from now.
Precisely. And they're not just sitting on this asset, they're executing. The report makes a big deal of this. They recently smashed their own production guidance for 2025. They targeted 1.4 million pounds of uranium, and they delivered over 1.6 million.
In mining, beating your targets like that is a huge confidence builder.
It tells you management knows what it's doing.
Okay, now let's get to what the analysis calls the hidden asset. This is where it's not just about uranium anymore. We're talking rare earth elements.
This is the real bonus catalyst. They are using that same White Mesa Mill infrastructure to build out a domestic supply chain for rare earths, or REs.
And just to remind everyone, REEs are what you need for everything. EV motors, wind turbines, defense tech,
All of it. And right now, the U.S. is almost entirely dependent on China for them. So EU is positioning itself to help solve two critical national security supply chain problems at once.
Using the same key asset?
Using the same key asset. It gives them this embedded strategic advantage that a pure-play uranium miner just doesn't have.
That dual exposure is really compelling. But let's play devil's advocate, because we have to. Mining stocks are famously risky. They need tons of capital. They're often loaded with debt. Makes them super vulnerable. But this report calls UU's balance sheet a financial fortress.
It's a bold claim, but when you look at the numbers in the report, it really holds up. First off, they're sitting on nearly $100 million in cash and marketable securities.
Okay, so they have a war chest.
A significant one. But here's the part that really earns them that fortress label.
Yeah.
Their debt-to-equity ratio is effectively zero.
Zero debt. In a mining company that's in a growth phase, that's almost unheard of.
It's incredibly rare. They aren't beholden to creditors. They don't have these huge interest payments draining their cash flow.
So what does that mean for their ability to handle, say, a temporary drop in uranium prices?
That's where it gets even better. The report points to their current ratio, which is a stunning 11.5.
An 11.5 current ratio. Just to translate that, a healthy company shoots for maybe a 2.
Right. So an 11.5 means they have enough liquid assets on hand to cover all their short-term bills more than 11 times over.
Wow. So it's basically a shield. They can ride out serious market volatility without having to panic and, dilute shareholders to raise cash.
It fundamentally changes their risk profile. You have a unique asset, great execution, and the financial strength to play the long game.
That's a rock-solid fundamental case. But we know the market doesn't always care about fundamentals in the short term. So let's talk technicals. The report notes the price is around $18.34. After that huge 200% run, what is the chart telling us?
Well, according to this analysis, the chart is showing a very necessary and very healthy pause.
A pause. So it's not a sign that the momentum is dead.
Not at all. The stock couldn't just go vertical forever. It's now moving sideways, which technical analysts call a consolidation pattern, or sometimes flagging. Basically, the stock is catching its breath. It's allowing the long-term price averages to catch up, and it's building a new, higher floor of support.
So it's building a foundation for the next potential move.
That's the idea. It's reinforcing the gains it's already made.
So what are the key levels you need to watch? Where's the floor, and where's the ceiling it needs to break through?
The analysis identifies a pretty solid floor around $16.50. As long as it holds above that, the bullish case is intact. The critical breakout zone is clearing $19, maybe up to $20.
And what happens if it gets through that zone?
The report is clear on this. Once it's decisively above that $19 to $20 area, there is, quote, very little resistance until it tests its recent highs.
So breaking that level would be like opening the floodgates.
From a technical perspective, yes. It clears a major psychological hurdle.
Okay, but what's the bear case here? What's the signal that this pattern has failed?
That's a vital question. If it were to lose that support at $16.50, that would definitely challenge this bullish thesis. It would suggest the sellers are in control. But, and this is the key, because of that financial fortress balance sheet, the company is in a much better position to survive a deep dip than its peers.
Right. The fundamentals are their insurance policy.
Exactly.
So let's talk upside potential. What do the Wall Street price targets in the report suggest?
They're pretty encouraging. The median target, so the middle of the pack, is around $24. But the high target mentioned in the analysis goes all the way up to $32.
Let's put that in perspective. From around $18, that median target is what, a 30% upside?
About that, yeah.
And the high target of $32 is a potential 75% gain from here.
Yeah.
Even after it's already run up 200%.
It's substantial.
Yeah.
And it really reinforces the report's main idea. The easy money off the absolute bottom has been made, sure, but the big money might still be ahead. The thesis is that the market still hasn't fully priced in this fundamental transformation of the whole industry.
Which brings us to our final takeaway. This is clearly a bullish analysis. It paints a picture of UUU as the domestic leader. Perfect assets, perfect timing, perfect balance sheet.
Absolutely. The core conclusion is pretty simple. If you believe in this nuclear supercycle and you believe the U.S. has to secure its own uranium supply, then this current period of consolidation, this sideways churn around the $18 mark, is what the report calls a prime accumulation zone.
A compelling case, built on readiness, resilience, and timing.
It is. And that leaves us with a final provocative thought for you to think about based on everything in this report. Given the White Mesa Mill's unique position for processing both uranium and separating rare earth elements, how much is the market underestimating the value of that hidden asset? I mean, it's a single piece of infrastructure that solves two of the biggest U.S. supply chain vulnerabilities at the same time. What is that dual threat capability really worth in the long run? That might be the real story here.